In the beginning, I'm going to cover the bias going into Friday because that was a question on the YouTube video that I wanted to address. I know a lot of people probably didn't watch the full live stream recording. If you have time, it's an hour long, but it's a really, really high quality tape read on Friday. So that's posted in the YouTube vid section as well, the March 14th tape read. But if you want the skimmed down version, I chopped it up and put it as a public YouTube video, which is also posted in that section. So we'll get into the bias here. I explained it on that stream, but going into it, and I think my expectations also for Monday, by the way, is most likely we're going to run out this Wednesday high and potentially into the previous new week opening gap up here. I like that as a potential draw on liquidity for this week, especially if Monday and Tuesday we can start to see some expansion through these SIBIs and such. But going into Friday, anytime we're after Wednesday or so, you can start to kind of frame a weekly profile or a weekly model. There's going to be some weeks where Monday's going to have a large expansion, or Thursday's going to have a large expansion, where sometimes it's hard to figure out a weekly profile. So that being said, I don't think there was a clear weekly profile last week that you could have utilized to be like, oh, okay, we're going to be expanding on each of these days. I think day by day, you kind of have to just find a bias. And sometimes that's harder. But obviously you're still just using the same process into each individual day to just kind of frame your setup. But we're starting to get some decent PA where now it's getting a little bit easier to find the biases and find lower time frame trades, which is pretty solid. But going to the week, you can see the new week opening gap opened up here, and then Monday we just sold off and basically completed the sell model we had from the previous week. And then we're stuck down here just consolidating. So going into Friday, we had this 4-hour SMT at the swing lows between ES and NASDAQ. And anytime I see that, it's typically an indication of a potential weekly reversal. I need to see, obviously, the other tools in mind of displacement, SISD, etc., for it to be a true market reversal. So when I see that coming in, and we obviously failed to take out that swing low, which is Monday's swing low at a previous day or the current week ERL, we start to expand away. There's not really a clear swing high or SISD on the 4-hour, but on the 1-hour, actually, we'll stay on here first. But despite that, if you see the, I've got midnight basically marked out here, but I want you to notice inside of this, there's a tiny inefficiency. Now, a lot of people either aren't going to see this or they're going to mark it out like this, which is incorrect. So if you saw this, some people are going to think, oh, that gap is too small, so it's not useful. I don't know where that lie came from, but there's no such thing as a too small of a gap. Okay, so in this case, there is an inefficiency here. So either if you didn't mark this out, that's fine. But if you marked it out like this, it's actually incorrect. Notice how there's a VI down here, and you have to include that into the inefficiency. So now you can see, okay, despite it being a small gap, now it's actually quite large. You have a larger buy side imbalance, sell side inefficiency after this sell side is failed to be swept. So the SMT is creating. So the SMT is created, then you have displacement away within efficiency, and then it's tapped into and respected. And then if you go down to the 1-hour chart, you can see a little bit more clear PA. So in here, you have an SMT protected low, and then you have a swing high that's shifted above. That would be a market structure shift. You also have a SISD through this down closing candle as we displace through that. There's not really a lot of inefficiencies. You have one here, it's respected with the order block. You sort of displace, we have a tiny one there as well, it's respected. But that would be the framework for as to why you'd be looking for potential longs, and I'll get into the framework on the lower time frame as well. But I don't think there's any reason to be looking for a continued short move going into 10 a.m. because of, I think this is very low resistance as well. So anytime you see these kind of stacked highs, or a lot of retail traders will look at this as trend line liquidity. We have this huge like kind of trend line it's bouncing up against. I love to see this. Anytime you see this kind of diagonal trend line forming, obviously same thing with relative equal lows, that's a pool of liquidity. And obviously this is even better because each of these highs, there's going to be stops on, and it's going to really want to run up quickly to take all those stops. So that's why I believe that this is potentially the current week draw on liquidity for tomorrow. But you can see all that low resistance, and then down here we have the SMT, and now we're starting to respect bullish PD arrays. There's not a lot of inefficiencies on the left side. So in this case, I can argue, okay, the bullish order flow is stronger than the bearish order flow, and there's no indication that's whatsoever to point that it wants to continue lower, because to me, this is a very high resistance sell side pool to be ran. And then obviously on the 15-minute chart, as we drop into the lower time frames, you can start to see the session liquidity pools playing out, where midnight opens up, we drop down into that higher time frame gap during a key time. It starts to expand away. We have inefficiencies forming on the 15-minute and being created, and that's what we utilize going into the morning session for our longs into the PM session high, actually into the buy side from the previous day. But regardless, you have an inefficiency and discount here. Actually, take these off really quickly. We have an inefficiency in this short-term dealing range discount. That's the inefficiency we're going to be using, the IRL, as prices rebalancing into that, as we draw for the ERL, either in the form of previous day high, which is the low-hanging fruit, or on kind of these stacked highs over here. And obviously that's why we kind of ran that out the PM session, and then we started to retrace back into the inefficiency in here. But to me, that looks very, very clear as to why we're trading up. Notice also how there's no inefficiencies on this left side besides this one. It's already been wicked into, and as long as we're showing a willingness that we can close through that through here, the 930, it should be pointing to, okay, we're likely to keep going up. If you want the lower time frame analysis, that's on the live streaming and the chopped up recording, so I'm not going to cover that, but that's kind of how I got a bias going into Friday. And really, for me, it's just a combination of the 4 hour, the 1 hour, and the 15. If I had to, gun to my head, pick a time frame to find a bias, just one time frame to find bias, I would pick the hourly chart. The hourly chart is very versatile in the sense of you're going to find proper targets, you're going to find proper inefficiencies prices trading into, and if you can blend that as well with the 15-minute chart, you can find very refined levels that price is going to respect. Because in terms of a daily bias, I don't really like to use the daily chart all that much. I can reference PD arrays on it and use different things. Obviously, if there's a very clear sell side pool or an inefficiency, etc., I'm going to utilize it. But I'm just trading the New York session most times. I'll maybe be holding it at PM, or I'll be trading PM occasionally. But for the most part, I'm trading the AM session. So I want to find a session bias. Sure, it may be the daily bias as well, but where are we going for the New York session? That's where I want to determine what's the highest likelihood. So it's either rebalancing or running liquidity. And if I can't argue one side over the other, that's the definition of low probability. So when I'm waking up in the morning and I'm deciding whether or not I want to trade, first thing I'm going to is the hourly chart. I'm just scrolling back and forth, looking at the hourly chart. If it looks clean to me, I can kind of distinguish that probably within the first 20 seconds. And then if I can see something, okay, there's a gap or whatever, then I can go to the 15, go back to the 4, and I'm kind of just refining down my bias using those 3 time frames. And then I'm not dropping to the 5-minute or the 1 minute at all until I have a better understanding of what the higher time frame is doing. Because if you're just trying to go into the session at 9:27 and look at the 1 minute chart, you're going to be lost. Every single price fluctuation is going to pique your interest, and you're going to think, oh, maybe it's going this way, maybe it's going this way. And you're not going to be able to discern whether or not your bias is incorrect, or if this is just variance, where maybe we're manipulating slightly too far. Right, like 10 a.m. The 10 a.m. news on Friday was a great example of, it's kind of this variance where the bias is still bullish, but someone may be going into this and looking at, even me on stream, I was hesitant as this 10 a.m. news came out. I'm like, okay, we did run out that low. If we were to run out this low, I wouldn't touch it. But the fact that we kind of came in, we respected some of this wick, also the 15-minute IRL, this one in here, we were respecting, and then we started to get displacement up. We traded back into that, also with the inversion gap, and that's where I went long in there. I probably could pull up the demo actually from Friday. Went long in here. I got misfilled on my stop, but went long, bought another one in there, and then sold above the highs. And then I tried to hold it for the end, but I got stopped out right there, right before I ran out the buy side. But that was the model there. So I don't think overall it was an extremely difficult day. But the benefit of kind of going through the winter PA in December and January is now as we get into spring, it should be quite easy. Like you should be looking at the 1 hour and the 15 and the 4 hour and spotting, okay, is there a gap? Is there liquidity? Which one is it running for? Very, very simple question to ask. It's running for one of those two. And if you can't overly argue a reversal. You just trade the continuation. That's it. So whatever price, the direction that price is already moving in, that should be your soft bias going into the day for the most part, right? You're kind of like, okay, yesterday was extremely bearish. Today I'm expecting probably a continuation off of that move, unless there's SMT, SysD, displacement, bullish PD arrays being respected, and now we're leaving that, but I'd be like, okay, now price is reversing. So don't be too quick to anticipate a reversal, and don't be hesitant in entering into a expansion move. So these past weeks and the past kind of couple of days as well should teach you should not be scared of price going too far, right? We started dropping off mid-February. It's already been a month of basically downside price action, and we've dropped about 15% in the past couple weeks. And anywhere in here, someone may be arguing, oh, we're too far down. We're too far down. So anyone who may be thinking that, I want to encourage you to, first of all, stop thinking that, because it's just a lie. It's an illusion. And then kind of figure out where that illusion is based off of, because that may be as a first starting point for you of discovering kind of the lies that you tell yourself in psychology and that hold you victim to making the same technical and psychological errors, right? So find those illusions and then break them with logic and reasoning. So an illusion of it's gone down too far, it can't keep going down, is going to constantly try and make you find bullish bias. And because there's obviously reasons for everything in this market, you're going to be able to have confirmation bias and just argue your side of the market without actually thinking logically, right? So you want to be able to think logically and act logically without having any emotions or influence towards one side or the other because it looks like this or it feels like this. If it's not logic based, there's nothing in there, right? So that's my spiel that I wanted to start off with. We'll get into the questions now. So if you're just now joining, put any questions or things you want backtested quickly into the public stage, and then we'll go over that. I don't want to take too much time out of your Sunday night, so we'll probably wrap this one up hopefully within the next 30 minutes or so. Got a couple questions today. I wanted to see your thought process on how you determine which part of price is balanced versus which is not, and based on how price is playing out through the higher time frame, lower time frame, where you expect prices allowed to go versus where it isn't allowed to go if your draw on liquidity is correct. Got it. All right, so the first part of the question, how to determine what price is balanced versus unbalanced, I don't think there's really any way I can describe it better than ICT can. So if you're in the private group, if you go to the models and reviews tab, I believe. Yeah. I'll forward this message, but this will have like basically 4 videos you can watch. And in order, we watch those 4 videos and it'll be very, very easy. But those videos, I'll actually post it on the screen here. Let me, here, I'll just write it out on the screen and then I'll screenshot it. So it'll be the ICT 2025 mentorship. Like it's something about fair value gaps, like balanced, something like that. Then the next video you should watch to accompany that would be the ICT 2023 Advanced Gap Theory Introduction. Then you want to watch, this is just my own personal preference, but I talked about the same exact stuff back in 2024. And I have a couple videos on that should help further your knowledge on the topics. So it would be both the in-depth guides on the inversion fair value gaps and the how to read fair value gaps advanced guide. And both of these are by me. So you'll find those on my YouTube channel, probably in the content section. But I'll screenshot this and I'll put it in the chat if you want to go in and watch. Very, very high quality educational videos that are directly going to affect how you read price. So I highly suggest watching those videos if you have not seen them already. But to answer the second part of the question, higher time frame versus lower time frame, how I kind of navigate it, I can't really describe it, to be honest. Like it's kind of a process to me that's ingrained into my brain. So it's hard to articulate exactly what I'm thinking, obviously between each time frame. But for the most part, the rule of thumb for like when I'm determining, okay, is my bias correct or not, is if I start to see other data points piling up for the other side. So when I start to see things like SMT and a lot of the times order flow on the 15-minute or the 5-minute, this is really the cheat code for me. And if you see my live streams or if you've been in them before, you know I have the 5-minute basically pulled up right here during the live streams because I'm constantly referring to this. But if you are monitoring the 5-minute order flow and the 15-minute order flow, really after the first 15 to 30 minutes of the market open, if it's not showing you any willingness to reverse towards your draw on liquidity, you're most likely wrong. Okay, so the first 30 minutes of that session from 9:30 to 10 o'clock, you should probably write this down if you don't understand time. But the first 30 minutes, you want to see the Judah swing for the New York session most times, okay? This is not obviously a guarantee. This is just for days that's likely to play out. This is what the rules that I follow. First 30 minutes, you want to see the Judah swing, preferably the first 15 minutes, okay? Obviously, the less time it takes for that Judah swing to complete, the higher the quality of the session is, where you can just get a very energetic trade. So if 931 creates the low of the session, I'm expecting there's going to be a pretty large range move for that entire day or for the session. But 9:30 to 10 o'clock is your kind of Judah swing framework. So I'm not really looking to trade. That's why most times I'm waiting for 9:50, because between 9:30 and 9:50, I'm expecting that Judah swing to form. So I'm allowing for the first 15 to 30 minutes for the 5-minute order flow or the 15-minute order flow to potentially be opposing my draw. So I know, okay, if my draw on liquidity is bullish, for example, I'm expecting most likely we are going to drop into, these key times. So 9:30 and 10 o'clock. We're going to be respecting bullish PD raise on the 15-minute or the 5-minute. Now, because I'm using a session framework here and not an intra-session framework, where's the entire session going, I'm looking at the 15-minute chart, 15-minute or the hourly. So as I see, okay, price is respecting a 15-minute PD rate, maybe overshooting it a little bit, but we're holding with the candle bodies. That to me is indicating, okay, price is willing to move higher. And as well, it's being respected within that first 15 to 30 minutes. So to me, that's a really, really key point of me reading order flow is I need to see where's the 5-minute going, where's the 15-minute going. It can kind of play around in the first 15 minutes and maybe oppose the draw on liquidity, but it's got to be digging into a gap or a sell side if we're bullish, right? And if it's shooting past that sell side or shooting past that gap, there's got to be another one below it. If there's not another one below it, then I'm potentially looking for flipping bias. But before that, just because I'm seeing a disrespect of my bias, you got to have now a confirmation with the argumentation of the other side. So if I'm like, okay, if I'm bullish today, and then I see things that are pointing to, okay, maybe it's not bullish, that does not automatically mean it is bearish, right? It's a misconception that we think that, okay, just because our bias is wrong, we can flip, and it's clearly the other way. That's not always true. Sometimes it's going to take longer. So Friday is a good example where there's a lot of variance, where it's still bullish, but it takes the entire 30 minutes to kind of get that Judah swing over with, and then it starts moving up. I lost my train of thought. But yeah, I'm looking really for that. Oh yeah, exactly. So just because I can't argue bullish, I need to go back and see, okay, maybe my bias is bullish and it's wrong. But then I have to go back in and argue, is it bearish? Is it bearish, or is it just going to enter a consolidation? It's going to lure me in to take trades that are outside of my model. Because for the most part, I'm at a position now where I think if I have a clear bias, I'm quite confident in it me being right. If I'm wrong, that's great. But for the most part, if I have a clear bias one-sided, I kind of know where it's going for the most part and how it's going to play out. So if I'm wrong, I'll adjust. Okay, I'm wrong in that scenario, but I need to see SMT in the other way, SysD on the 5-minute or the 15. I need to see displacement on the 5-minute and the 1-minute towards the draw on liquidity. I need to see PD arrays on the 5-minute, the 1-minute, the 15-minute, all being respected and it's pointing downwards. I need to see a clear draw on liquidity. I need to see ES, YM, and NASDAQ all moving the same direction with DXY counter. Like, there's got to be a ton of stuff. So if you're just kind of going into it and thinking, okay, I'm going to spend 5 minutes to find my bias, you have there's no confidence in that bias, right? You've built it on nothing. You built it on sand. It was very easy to just sift around and get lost in it. But meanwhile, if you spend 20 minutes and argue, okay, every single point as to why it's bullish today, and then you see every single one of those points broken, you know, okay, I'm most likely I can flip bias on this day, especially if it's a high probability day, to find an entry. Low probability days, you should not be flipping bias. And I really don't think anyone in the new category, like prior to 6 months of learning, should be flipping bias. So if you're 3 months in and you're trying to go back and forth between the times, you're going to get lost in it. It's very easy to just get lost in price action and overtrade because of that. So that's kind of my process as flipping bias and kind of going down from the higher time frame to lower time frame, and really kind of how I expect drawn liquidity to either still be true or false, or if I want to sit out. Okay. Tapesh has the question, psychology based. Can I get over the hump of overtrading and revenge trading despite failed PA accounts? My setups are great, but taking a loss I cannot endure. So I think if the setups are great and you really trust the model, then it's not going to be there. Anyone who's dealing with overtrading, a lot of the times is because you don't trust your model enough. You don't have enough data to back it, where you don't actually know how it works and the intricacies of when you lose and when you don't lose. If you actually have a good model and you're overtrading, it could be greed related. It could be that you know, sometimes there's a problem that only shows up later on into the journey. But it also is just maybe your perception of a loss in general, right? If you expect a loss to be something that's wrong, you're constantly going to try and fight it, and constantly going to try and you know, fix the problem, which is not the right thing to do. So most psychology problems are either based in a lack of data or a lie and some sort of an illusion. So understanding that losses are not part of it. I hate when people say losses are part of it. It's true, but losses, in the grand scheme, they're built into your model. Like, you're supposed to lose, right? It comes back to the coin analogy. I think that's the best analogy there is about trading, where you just have a weighted coin. It's 80% heads, 20% tails. And every single time it flips heads, you make money. Obviously, you're going to lose money sometimes on flipping the tails, but that doesn't mean that the coin is broken. So I would say, like, you gotta kind of have to figure out, look at those days where you fail the PAs and obviously revenge trading, and look at what was the stimulation. There's some sort of stimulation. There's some sort of a kind of a dopamine spike of you acting to overtrade, and it's based on some sort of illusion that you have of your model or of trading as a whole, or just on kind of a lack of data. Because sometimes you have a lack of data of things like even simple things where maybe you have an entry and then it gets close to your TP and then it comes back and stops you at his break even. But since you haven't experienced that before, it's a new kind of feeling for you. And then that creates the uncertainty, that creates kind of the downward spiral, the snowball effect of overtrading, over leveraging, and blowing the account, which everyone can relate to. So I can't really pinpoint exactly what may be the issue, but those would be some suggestions as to what could be causing it. It's probably the perception of losing, or you got to just study your own model more. Thought if ICT said if a wick goes above the 50% of the free value gap, even though there's a VI, you don't mark on the VI or something like. Either I didn't listen to that, or I can't think of anything like that. Wick goes above the 50% of the. Yeah, I don't think that's true. Listen, I'm tripping. Can you please tell us what your high probability days are? Yeah, I'm supposed to make a PDF. I totally forgot about that. I'm supposed to make it this week. But I'm probably gonna, this week, if I remember, I'll make a document that'll just be based on high probability days. But in terms of anyone who's new, or if you're struggling to find days that are high probability, you want to be looking for 8:30 news days, and then days without news, and no news the next day. Also trading after the weekly reversal. So that means you're not going to be trading on Monday. You're not going to be trading potentially on Tuesday. Tuesday doesn't make the reversal. You want to be finding the days that are likely to expand off of the reversal of the weekly perspective. Okay. So that's really, if you want to find high probability days, it's going to be in line with the weekly draw, right? ICT always says that, but you're not going to know the weekly draw sometimes on Monday. Okay. So you don't need to find the weekly draw on Sunday or Monday. Okay. Weekly outlooks are great, but a lot of times they're wrong because you're not going to be able to predict day by day by day, 5 days in advance, what it's going to do. Because there's going to be things that come out like news. There's going to be things that sometimes you can't predict and anticipate that kind of ruin a weekly model. So what you want to be doing, the easiest thing you can do is you want to be waiting for some sort of a weekly reversal. So a 4-hour PD array, H4 PD array, or higher, greater than or equal to, engaged, and then shifted away from. And then once you see that, and you see something like SMT, SysD, exact, etc., then you can trust, okay, that at least the next day is going to be the bias towards the other direction, right? So if you have a weekly bearish reversal, I would anticipate as long as we close somewhere down here, the next day or two are going to be in that direction. Okay, and that's why Friday, sometimes you can go back to the Friday bias, and that would be kind of the explanation for that. But really just trading after the weekly reversal has been put in, but these two kind of criteria is going to be, like I said, basis. It's way more than that. It's news, it's economic calendar, it's higher time frame, it's lower time frame, it's everything. So you can't just say, okay, here's one day to look at. It's also based on your model. So if your model is silver bullet, it's going to be different than the high probability days that I like to trade. I think 10 a.m. news days are typically more difficult for me for whatever reason than 8:30 news days or 9:30 non-news days. Just because of how I trade with the 950 macro and 9:30, sometimes it's a little bit funky and I have to wait till silver bullet. And that patience for me isn't, I got to constantly kind of manage my mental capital during those days where I have to be patient, wait for the setup until everything is lining up, and then I'm able to execute. Or if nothing shows up, you walk away. What do you think about the Twitter model by MMXM Trader or maybe the Forever model by Sniper? I think between the two, I haven't seen the Sniper model, but I know the MMXM, the Twitter model that he had was pretty solid. I see a bunch of people having success with it. So, but I think it's not only for Forex, but it works better on Forex or when you have multiple asset classes you're watching because he relies solely on a very mechanical higher time frame model where it may not show up for sometime weeks. So maybe not weeks, but it's going to be very, very less frequent trades. So it's better if you're watching multiple asset classes like Forex, where you can just kind of monitor multiple time frame charts. Same thing with, I know Sir Pickle does the same thing. But ATM model, I've got a whole playlist on YouTube about it, but it's really just the M15 SMT 5-minute confirmation of order flow, and then a 1-minute entry utilizing time and a 2022 or unicorn entry technique, whatever you want to call it. But that's the ATM model. Really, all models are the same. It's just whatever PD array you like to use, right? We're all getting in the same order flow. You could realistically mark it in wherever you want, as long as your stop is in the right position and your bias is right. It's going to keep going that DOL. Tuesday, Wednesday, low probability. Monday depends on where we open, and Thursday, Friday, high probability. I trust your judgment on that one, Assyrian. I assume you're correct. Let me double check. Ouch. Yeah, Monday we got 8:30. Oh, Monday we have 8:30 news. What the heck? Oh, we got FOMC. All right, so yeah, Monday. My expectation would, I mean, Wednesday's going to be the worst. So my expectation would be Wednesday. Let me see. So for this week, okay, Wednesday we got FOMC. So I don't trade FOMC. I don't the AM session right before FOMC is usually dog, so you just skip that day completely if you trade the New York session. So Wednesday FOMC is going to be the worst. So from lowest to highest. Then most likely Tuesday will be second worst because it's non-news, and we have FOMC the next day, so that wouldn't be a bad suggestion. Then probably Thursday is the best because we've got 8:30 news. I would expect Friday to probably follow that. I'll say Friday, Monday. Yeah. That'd be my expectation from lowest to highest. So highest being Thursday, then you kind of go backwards from there. So I would completely skip Wednesday. There's absolutely, so this would be like, Wednesday would be no trading at all. I wouldn't even wake up for this. Tuesday, this would be like a medium to low. So really, if there's not anything really high quality, I would just skip that day. Friday, Monday, I would judge this as medium. You just kind of want to show up and look for a bias. Thursday is going to be probably the highest probability where you're most likely going to get a setup. But like I said, you would just wait for the weekly reversal. Whenever you have a high impact news, something like FOMC, a lot of the times it's either, as news is either going to be manipulation or expansion. So you would expect either Wednesday is going to be the weekly high or the low for this week, or it's going to be formed before that potentially on Tuesday or Monday, and we're going to have a classic expansion week, meaning you're going to have, this is some sauce, but in this case, this is kind of how you read the economic calendar, right? So FOMC is a very high impact news where typically you have manipulation or expansion on a weekly perspective. Okay, I'm thinking about the week. So weekly, meaning it's going to be either the weekly high or low, or it's going to be used as expansion within the week. But we can't expand unless we reverse. So I would expect in this case, the weekly reversal is placed beforehand. What do we have before that? We have Tuesday non-news and Monday 8:30 news. So most likely, potentially, Monday would be the best case for a reversal. And in that case, if Monday is the weekly reversal, it's going to be a classic expansion week, meaning Monday is reversal, Tuesday, Wednesday, Thursday, you're expanding, Friday, retracement / TGIF. And that's how you kind of predict the entire weekly outlook. And then you pair this kind of non-chart reading with the higher time frame, the 4 hour, the weekly, the daily, the 1 hour. And you look at, okay, where the higher time frame PD rays, where do I think each of these news days are going to play in to what's going on the higher time frame? Okay, and then that would be kind of how you read the economic calendar. So you'd expect this week, potentially, the weekly profiles is either going to be a classic or midweek. Now, do I care which one it's going to be? Nope. I don't care if I'm wrong either. All you're looking for is the same sort of, you're just looking for a weekly reversal, like not pattern, but you know what you're looking for. Higher time frame PD array engaged, and it leaves it. Shows a willingness to respect that higher time frame PD array, and the PD array is formed after that. There's your bias. Okay. Do you think we need to use RTH gap to confirm bias, or is it just noise? For me, it's noise. I never really utilized it all that often to where I'm confident. To me, it's noise. So I may look at it once a month, but to me, it's any of those gaps like new day opening gap, RTH gap, and new week opening gap, I very rarely will utilize. New week opening gap, I can, when it's reasonable, like kind of using that as the weekly open, if you would. Like midnight open, you have the weekly open. How to utilize 2040, 60 day lookbacks into your very, very rarely. It's on quarterly shifts. So whenever I expect like a whole month to shift or like a couple months to shift, then I'm looking at those lookbacks. Especially when we're trending for a very long time. Like in this case, since we're trending on such a higher time frame, this is where you could probably go to your 20-day up to lookbacks and start hunting that down. And looking for that sort of stuff. Like 20 days would be where, basically around here. So you have your 20-day up to look back. You got these swing highs in here. All of this is what I was talking about earlier into the stream. Very low resistance in here. Right. When's a good time to move your stop? Good question. So you've got easiest way to move your stop and trim it is going to be like this. You have, say you're going short, you just flip, you kind of vice versa this for longs. But basically, if you're shorting off of a premium imbalance here, every single time we form a fractal market maker sell model, you trim your stop. So in this case, if we were placing our stop originally up here, you would keep it here until we break this low. We form a new high and then we displace and break past this low. As soon as you break past this low, I can trim my stop either to here or to here if it's reasonable. Then when we have another trades up, I'm not placing my stop and trimming it here as soon as we create that swing high. I'm only trimming my stop once this low is taken out, then you can trim it to here. Also using things like order blocks on the 5 minute is going to be super, like it's just kind of a textbook sort of thing to do. Just use order blocks on the 5 minute, use order blocks on the 15, gaps on the 5, gaps on the 15 for really, really safe stops. Sometimes they're going to be too large where you got to refine it down to the 1 minute. But anytime you have a fractal market maker model forming, so if I'm entering long in here, I need to see this high broken. That would be a confirmation of my trade. That if I see something like this, then I'm trimming my stop from here to then to here. And then when I see another one, boom, it takes out that high, trim it to here or to here. It's really based off of, like, if I see a gap down here and I see price trades up, it rebalances it, and then we start to leave. To me, if I got in here, say I got in and there's a little trade in here, and then I see it perfectly rebalances this inefficiency and then it starts to leave it, I can really trim my stop to here before it even takes out that high, because I trust that this is going to be perfectly balanced and then it's going to start to move. If it was to trade below that, I trust it's either my drawn liquidity is incorrect or it's entering a deeper retracement, filling a gap in discount, etc. And then we'll move higher off of that. Okay. Use new week opening gap as extra confirmation on specific cases. Yeah. Yeah. I use it specifically for just a weekly open. So I can gauge whether or not if we hover around the new week opening gap. So look at, like, if Monday, Tuesday, Wednesday is all hovering around the new week opening gap, it's most likely a consolidation reversal profile where you're not going to be trading until Thursday. Obviously you're not going to know that until Wednesday comes in, but weekly models, for the most part, the good rule of thumb is when you're looking at weekly profiles and weekly reversals, you don't really incorporate a true weekly profile until Wednesday. Before that, it's, unless you have a really like confident explanation as to why it's maybe a classic or a midweek, then you could use that. But for most people, I would say you just wait for Wednesday, just like how you wait for news. Sometimes you just got to be patient for things, okay? Like 8:30 news, I don't think anybody in the beginning, you should be trading those volatility drivers, 8:30, 9:30, or 10. You let them come out, you let them give you as a data point, then you can frame a very textbook low risk setup after that. You can go with those high risk setups once you understand how price moves and what it's likely to do at key times. But until then, focus on the very clean, low hanging BISIs to go long, SIBIs to go short, and that's it. When you get good at the very minute stuff, it's easy to get good at turtle soup. It's easy to get at SysD entries. It's easy to get at whatever entry you want to use, because you know, okay, you can just kind of work backwards. Before the inefficiency is formed, it's got to create the inefficiency. Before the inefficiency is created, there's got to be a market structure shift. Before the market structure shift happens, there's a turtle soup. Before the turtle soup happens, there's going to be a higher time frame PD rate, lower time frame consolidation, higher time frame SMT. There's like a bunch of stuff, right? There's every model has these things that are going to happen before and the things that are going to happen after. So if you kind of figure out where in the cycle you want to enter, you can just look behind it and look ahead of it to see what do you need to see to get into an entry and what do you need to see that confirms your entry is likely right or wrong. because anyone who's been trading for more than 6 months will know, okay, within the first couple of minutes or even the first couple of 5 minutes, you'll know whether your trade is right or wrong just because of how it reacts. There's not really something you can explain. Sometimes it's just you see, okay, it's taking too long, or it's not printing the way it should be printing when price action is correct. It should be running aggressively. Like this kind of energetic runs, that's what you want to see. Not this lethargic kind of just chopping around, not really giving you a whole lot. Right? So, anyways, I may actually just post this on public, but who knows? Yeah, we might. Well, we could probably do a FX replay. We'll do one probably this week on one of the days that are low probability. So maybe Wednesday. We'll have an FX replay session because those will take normally like 2 hours, 1 or 2 hours, and it's already 9:23. I know some people either are in Asia and you just woke up, or you got to go to sleep soon. Yeah, the last FX replay session we did was 2 hours, I think, because each day it's like it just takes so long. But yeah. Anyways, so if you got any questions, the FX replay session, it may only be private. I don't know. We'll figure it out. I'll let you guys know before it happens. But anyways, I'll wrap this one up. We've been going for about 40 minutes. So if you got any questions, obviously that I didn't answer, you can shoot me a DM. I've got a couple to answer. Got 1, 2, 3, 4, 5, like 30 or so. So if I don't get to you today or tomorrow, I apologize. I get to you probably on Tuesday or Wednesday. But yeah, if you got any questions, put them in the chat. You could DM me. You could DM my admins. If you're interested in the tier 3 with, you get 4 hours of one-on-one time with me and then access to tier 2. So if you're struggling with the model or struggling with evals, whatever it may be, let me know if you're interested in that. There's only 7 spots total, and half of them are already filled. And then obviously, if you want access to the PDF, reach out to me or my admins, and we'll get that sorted out for you. One more question. One remorseful. When do you use standard deviation for Asia or London? I don't trade either one of those, but if you're talking about fib projecting from that, I would be fib projecting classic London protraction days where London is creating the higher low of the day. You can use that as a projection. So notice how that's actually a good question. This is your retracement opportunity for the higher time frame, but it's the reversal on the daily perspective. So this entire thing, you can take this and project this either here or to here, either one. And you see, where does that line up with the higher time frame? So -2, -2.5 in this case lines up with the previous day high. You could refine that down on the lower time frame, like here if you wanted to, and see it lines up in there. Also, I guess for the confirmation of it's the fact that it's closing through that, we're likely to reach for -4. So you look at that as a potential draw for this week. But really, I'm looking at it as is London forming the low of the day? Yes, then I can use that as a fib retracement kind of thing, right? And that this is something you could look into. So that means on a lower time frame, retracement legs, you also can standard deviation. You can standard deviate to match up with the reversal leg, and you can get these overlapping sections, right? So when you see these kind of retracement legs, every single time it's offered, you can be using that as a target in price. Okay, so every single time you see one, you just kind of standard deviate, standard deviate, standard deviate. When you see this cluster of them lining up, like over here, and it lines up with the higher time frame PD array, and it lines up with something to the left, like that high or whatever higher time frame stuff, then that would be a true target. And that's not something made up. You can go back in and listen to the 2023 mentorship from ICT, and it'll be in there. Like predicting where the higher day. Yes. Yeah. Except I would be using Assyrian. If you're using like London to standard deviate, I would be using like the true targets of -2 and -2.5. The -1 I only use for opening range. Right here to here. Like that would be your -1. Oh, it also lines up with the -4 from previously. So pretty high quality draw up there, I think. The one-on-one is for daily time. Yeah. If you want a one-on-one, you can schedule individual ones, and you can just reach out to me, and we can set that up. But if you want like a kind of a scheduled repeating thing, the best option would be tier 3, because that'll give you one per week at a discounted price plus access to tier 2. And that, well, I've already worked with at least probably 10 or so people. A couple of them are getting payouts, and doing very, very well in terms of the learning. Like the learning has been accelerated 10 times. And you could ask them for themselves as well if they choose to um, reveal themselves. But I would say, at least I feel confident in the growth that they've seen. So yeah, if you got questions on that, or if you're interested, to reach out to me or my admins and we can set you up, or just want to register, then it'll be on the Patreon, like I mentioned before. So anyways, this is recorded. It'll be posted on YouTube, unlisted inside the YouTube vids section. So if you want to go back in and watch it, I may actually just post it public, to be honest. Either way, it'll be access if you want to see it. And I'll hopefully see you guys in the private group maybe tomorrow for a stream. Otherwise, potentially Tuesday, Thursday, and Friday. So take care of the rest of your Sunday and into next week. I wish you good luck, good trading, and I will talk to you guys soon. Peace.